Are you shopping? Recently, I was tagged on a LinkedIn post on an interesting article that went into paying too much, borrower sophistication, and overpayment in the U.S. mortgage markets. This paper goes on to talk about there is a disparity between the 90th percentile and the 10th percentile of roughly 0.55 basis points or 0.55% of an interest rate between borrowers. It goes on to say that many borrowers, especially those that are less financially sophisticated, overpay when they get a mortgage relative to the best interest rates available. It went on to say that on an FHA borrower, on average, the expected gain from additional research of just one additional lender, one additional quote, was 28 basis points. As much as up to 55 basis points for ones that searched more than one additional quote. That's a substantial dispersion in the mortgage market, and it was observed through identical borrowers between the 90th and the 10th percentile. On a $250,000 purchase, that's a savings of roughly $6,250. Here's the thing. I actually believe that report. I, as a mortgage broker, am capped that I could never make more than 3%, but I never make more than 1%. So if you find a mortgage broker that makes or wants to make 2.75, 3%, there would be a dispersion of almost 2 points in that scenario. Keep in mind, 1 point is usually equal to roughly 0.25% in interest rate. So that rate dispersion in the paper was highest among FHA borrowers with low credit scores and highest among big banks. The overpayment also tended to increase when interest rates were low, likely because borrowers feel less compelled to search because they feel like they're getting a good deal. Just because you feel like you're getting a good deal does not mean that you are, and you should still check with another lender or mortgage broker. The paper actually goes into stating that larger lenders are more likely to have a larger dispersion on the rate. So the gain, the e-gain that you get by shopping them is also greater. This is consistent with lenders having more market power, higher expenses, higher costs, more employees. They have to make up their money elsewhere. I also argue that if you see someone's ads on TV, they're probably going to be charging you more. I call it a couch effect. This isn't in the report, but the ability for someone to apply for a mortgage that sounds great on the couch at midnight is sometimes typically not necessarily a good thing, okay? If you saw an ad on TV and then you go to their website, you're probably paying for that ad. It also shows, this article, that borrowers who pay higher rates are not more satisfied with the lender and the mortgage process, contradicting the idea that higher rates reflect better service. Just because you're paying more doesn't mean you got better service. So it also goes on to say that the most sophisticated borrowers pay rates about 23 basis points lower than the least sophisticated. How they can measure sophistication, I do not know, okay? But the benefits of greater competition are definitely going to lead to a lower interest rate, or EGAIN. Okay, the authors of this report were from the Federal Reserve Bank of Philadelphia and the Board of Governors. So these are some pretty significant due diligences done and the homework done on these. I do agree that shopping is important. I feel some of the biggest reasons for the disparity is the fact that consumers blindly go to the agent's choice of lenders. Here's the thing. You have to know who the agent works for and whether or not they're affiliated with who they recommend. That alone can be a red flag. But here's the thing. I'm okay with going with the recommended lender. Make sure you get pre-approved, give them all your documents, have your credit pulled, but don't stop there. Make sure you ask for your credit scores. All 3 of your credit scores for each borrower. This is going to allow you to shop other lenders. Clients, A, do not shop other lenders because of fear, lack of knowledge, or simply they just trust too much the realtor's recommendation. If that lender is tied to the agent in some way, you're probably potentially paying for something more than you should, okay? The agent's commissions could be based upon the referrals being sent there. And if that's the case, they may not have your best interest at heart. Always ask your agent for more than one recommendation. Also ask friends and family for other recommendations. You should always check with the lender and at least one mortgage broker or 2. Here's the thing. Not all companies can be all things to the lending world. You go to a big box bank and they may have great VA pricing but not good conventional pricing. They might have good conventional pricing but not good jumbo pricing. They may not be good in all facets. Mortgage broker has multiple lenders. He may have one that's good at VA, one that's good at conventional, one that's good at FHA. So going to a mortgage broker that has multiple sources tends to lead to a more well-rounded pool of resources to give you a better deal. I firmly believe that the competition between lenders can even be greater than the 55 basis points found in this particular article. Another problem is the builder lock-ins. Clients that go to new constructions, there's typically incentives and closing costs that require you to use their lender and title company. This, I feel, should be outlawed. Their client is captive. This definitely leads to larger disparities between interest rates that are able to be given. So in closing, I feel that this report, being a 55 basis point swing, is on the mark. I think definitely a 0.25% difference just by checking with 28 basis points difference by checking with one additional lender. I full-heartedly believe in that, and you should absolutely check with one lender and at least one mortgage broker, okay? That's going to lead to you at least being educated by at least more than one loan officer when it comes to doing a home purchase. In closing, I full-heartedly agree with shopping. The key to shopping is shopping on the same day when you get pre-qualified with the first recommended lender. Ask for a second referral. If the agent doesn't have someone else they recommend, go to Mortgage Matchup and type in a zip code, and you'll get a whole list of mortgage brokers that service that area. Here's the thing. Shop both lenders on the same day. Get estimates. You're not under contract yet. I stress that. 3 days later, get another estimate from them. 5 days later, get another estimate. You'll see a pattern on who is priced consistently better for you and your needs, okay? By doing that, when you're under contract, you won't be under the gun and worrying about shopping again because you've already done your homework. That's going to give you the most EGAIN or less disparity. This is going to save you money, not only today, but over the life of the loan. My name is Kevin Retcher, owner of First Meridian Mortgage, licensed in Virginia, Maryland, and D.C. Phone number 703-799-5626. Even if I'm not licensed in your state and you have questions, give me a call. I'm happy to guide. I have over 32 other states covered with broker owners just like me that I can refer you to, and I make nothing on it other than giving you good, sound advice. I'm happy to serve as a Marine. To all the Marines out there, I say Semper Fi. I'll talk to you soon.